Thanks for joining us today for our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So let's kick things off here with our chart of the week. This one we've labeled Inflation May Soon Become a Headwind. So we're showing the S&P 500 index in the top clip and consumer inflation in the bottom clip of this chart. Now note that the inflation rate peaked in the summer of 2022 and it receded over the past few years, providing a tailwind for stock prices. But inflation is perking back up and is not far from going from stock market tailwind to stock market headwind. For now, we'd call inflation more neutral, but some more tariff pass through and commodity inflation that could have us label inflation as a market headwind soon. Now, the S&P 500 did go out at a new all-time high last week, and that's encouraging. It confirms that the bull market remains intact, but participation hasn't been as inspiring as we'd like to see in this run-up to new highs. Here in the bottom clip of this chart in orange, we're showing the percentage of stocks that are above their respective 50-day average price. Historically, when this has reached 90%, the market's been up 1 year later 21 out of 21 times, and gains have been about double the average. So we'd like to see stronger participation to be more comfortable that the volatility will ease. Until then, our base case is that the market is likely to trace out its midterm year pattern, which has been challenging for investors until late summer or into the fall. Now, supporting the bull market is an economy that has continued to surpass expectations. This chart in orange shows the Citigroup U.S. Economic Surprise Index, and any reading greater than zero means that the actual data is coming in better than economists had forecasted. Now, it's been above zero all year long, and that's a good sign for the economy. But there are some downside risks, and that also could be an opportunity for the economy and for the market. So the inflation impulse and the weak hiring environment has seen consumer sentiment sour. In orange in this chart, you can see that consumer sentiment is at a cycle low. Back in early 2025, this indicator gave a warning sign that the economy was going to slow, and in fact, it has downshifted. The risk is that consumer sentiment remains depressed, and the opportunity is that should sentiment improve, it could support economic growth in the future. Now, the inflation impulse has officially shifted Fed policy from easing to neutral. This chart here shows that when Fed policy has been easing, the market has tended to perform better than average. Now, the good news is that neutral policy has not been a bad condition for stocks, but tightening policy has proven to be more of a challenge. As long as the Fed maintains an easing to neutral bias, then rates are not necessarily a market headwind. Speaking of inflation, the impact to earnings has tended to be positive when inflation is accelerating. And that's because earnings are measured in nominal terms. They're not inflation adjusted. This chart shows the ISM price index in red. And when it's been greater than 50, indicating that there's accelerating inflation pressure, earnings have risen at a 16% annualized rate. Now, the same cannot be said for stock prices. That same ISM price index has seen stocks fall 6% per annum, which it's when it's been here at this level. Now, we expect strong earnings and lackluster stock prices over the next few months, maybe even a few quarters. Now, the good news is that strong earnings with lackluster stock returns could help take the air out of valuations. So here we can see that the forward price to earnings ratio for the S&P 500 is well into its extremely overvalued range. And historically, when stocks are in their most expensive zone, the range of outcomes looking out 10 years is just very wide. That's the bar to the far right here in this chart. In the decade following extreme overvaluation, stocks have been up as much as 15% per year, but they've also lost as much as about 7% per year once we've adjusted for inflation. Now, the median return has been 5.8% when stocks start at a place of extreme overvaluation. Now, take a look at the far left bar and how tight the range of outcomes has been. When the market has started from extreme undervaluation, the next 10 years have returns 12 to 15%, with a median return of 14%. So, a valuation reset, maybe not all the way down to this extreme undervalued level, that could be a good thing for returns in the next decade. So, to close things out, inflation was not the story following its peak in 2022. Even though it remained in the headlines, it actually was a market tailwind as inflation was coming down. But it is potentially becoming something that we do need to consider more here in 2026 for its impact on stock prices, earnings, the economy, and consumer sentiment. Now, higher prices are a tailwind for corporate earnings growth because corporate earnings are a nominal variable. They're not measured in inflation adjusted terms. But higher inflation is a headwind for stock prices. And that could mean lower valuations and stronger return expectations for the next decade once valuations are reset. Now, new highs do confirm that the bull market remains intact for now, but participation has yet to signal the all clear for us. Our base case remains unchanged. The market is likely to be volatile into the late summer or fall season, and that would be consistent with past midterm year trends that we've seen before we move into some form of a year end rally. So that's what we have for you this week. And as always, I want to thank you for joining and wish you a great week ahead.